topics cause as much disagreement as employee stock options and how companies incorporate it into the accounting of their finances. Employee stock options are incentives originally meant to attract and keep talented workers, but in recent years, they have been a major source of debate amongst investors, regulators, and business leaders who all have strong opinions on the matter. Historically, employee stock options have been seen as a great way to ensure employee loyalty, as well as secure an employee's care and commitment to a company's success. Just like a shareholder, over time, this method of compensation has become embroiled in complicated accounting rules, as well as differing opinions such as figuring out how much the stock options are worth and how much information companies should share about them. This created a hostile environment of rules and disagreements, causing what started out as a good idea to reward employees transform into a form of chaos. From arguing about whether companies should count stock options as an expense to the tricky business of figuring out their actual value, these differing opinions make employee stock options unappealing. Stock option accounting affects the way companies report their finances, how they're run, and how investors see them. It's a reminder of the difficulty found in balancing new ideas with the need for clear rules and trust in the financial system. On this backdrop, in this article, we will assess the issue and discuss several ways to provide a clear understanding of how to get the accounting of employee stock options right. Expensing stock options, an ongoing debate. The controversy surrounding the expensing of stock options has been a source of tension for years, pitting those advocating for transparency of a company's financial position and performance against those worried about the effects on corporate profits. The expensing debate in employee stock options revolves around whether companies should include the cost of issuing stock options to employees as an expense on their financial statements. The ongoing battle between proponents and detractors of the expensing debate reflects a fundamental disagreement about how to accurately represent the financial health of a company. Proponents of the expensing debate argue that including the cost of stock options in financial statements provides a clearer picture of a company's expenses and performance. They contended that transparency is essential for investors to make informed decisions and for corporate governance to uphold integrity. Conversely, detractors raise concerns about the potential impact on reported earnings, especially for startups and high-growth companies with limited cash flow. They fear that expensing stock options could distort profitability metrics and discourage companies from offering these incentives, thereby hindering their ability to attract and retain talent. Arguments on both sides are deeply rooted in differing perspectives on financial reporting standards and corporate responsibility. The implications extend beyond mere accounting practices, touching upon broader issues of investor confidence, market efficiency, and the balance between shareholder and employee interests. In navigating this complex terrain, understanding the nuances of the expensing debate is crucial for investors seeking clarity in financial statements and for corporate leaders striving to strike the right balance between transparency and profitability. The Financial Accounting Standards Board, FASB, and the International Accounting Standards Board, IASB, have made efforts to address this issue by requiring companies to disclose the impact of stock options on their financial statements in footnotes, but the debate on whether to expense them directly on the income statement continues. Valuation methods. Determining the fair value of employee stock options is a challenge for accountants and financial analysts alike. Various valuation methodologies are employed by professionals in determining the fair value of a stock option, from the widely used Black-Scholes model, which is often the go-to method for valuing stock options, to determining the fair value of options and to make informed trading decisions, upwards to more nuanced and advanced techniques. The Black-Scholes model and its reliance on certain assumptions, such as constant volatility and continuous trading, has drawn criticism for its limitations in capturing real-world complexities. As such, financial experts have developed alternative approaches, including lattice models and Monte Carlo simulations, which offer more flexibility and accuracy in certain scenarios, but come with their own set of challenges and computational demands. A broader study on the strengths and weaknesses of each method can equip a company to overcome the challenges faced on each model, as well as provide a deeper understanding of how to value employee stock options, and as well as the implications on financial reporting and decision-making. Transparency and disclosure. The level of transparency and disclosure surrounding employee stock options varies widely across companies and jurisdictions. creating a patchwork of practices that can obscure rather than illuminate investors' understanding. While some companies provide detailed information about the terms and impact of stock option grants in their financial statements and annual reports, others offer minimal disclosure, leaving investors in the dark about the true extent of their incentives. Moreover, the lack of uniformity in disclosure standards across jurisdictions further complicates matters, making it challenging for investors to compare companies on a level playing field. In some regions, regulatory requirements mandate comprehensive reporting of stock option plans and their financial implications, while in others, such disclosures are optimal or non-existent. This disparity not only hampers investors' ability to assess the true value and risk associated with stock option programs, but also undermines the integrity and efficiency of capital markets. The study of the complexities of transparency and disclosure in the realm of employee stock options unveils that standard reporting practices and enhancing regulatory oversight are essential steps toward promoting greater accountability and trust in financial markets. By shining a light on the shadows of opaque disclosure practices, we aim to advocate for reforms that empower investors with the information they need to make informed decisions and uphold the principles of transparency and fairness in corporate governance. Bottom line, in conclusion, from the ongoing debate over expensing stock options to the complexities of valuation methodologies and disclosure practices, the landscape of stock option accounting is rife with challenges and conflicting viewpoints. However, as we navigate through these intricacies, it becomes evident that standardizing disclosure requirements and enhancing regulatory oversight are essential steps toward fostering trust and confidence in financial markets. By advocating for greater transparency, empowering investors with accurate information, and promoting integrity in corporate governance, we can strive towards a more equitable and efficient financial system that aligns the interests of all stakeholders. HWAA can help you. Ready to navigate the complexities of accounting for employee stock options with confidence? Let HWA Alliance and CPA Firms Incorporated, HWAA, guide you. Our expert team specializes in providing comprehensive accounting services tailored to your needs, including accurate valuation of employee stock options, transparent financial reporting, and regulatory compliance. Gain clarity, transparency, and peace of mind with HWAA by your side. Contact us today to learn more about how we can help you navigate the intricacies of stock option accounting and achieve your financial goals.